Hear ye GameStop. We've all gathered today to talk about one of the most pressing issues this country has ever seen. To talk about one of the most viral and upsetting things ever. Normal trading action. So obviously it might still be going on. Today, February 17th, there is a House representative hearing about the appreciation of GameStop shares on January 26th. Just a quick recap of what happened. Again, short squeeze, price appreciation, then depreciation. Just go look it up if you don't know what I'm talking about. But the hearing was today, and frankly, it was pretty much more or less exactly what I expected. No real manipulation, right? If the facts, from the last episode about GameStop I made, what were they talking about? I wasn't sure what the short interest was. Like I said, I wasn't sure if you could short more than the available float. Then I didn't know what the short interest was on GameStop, but it turned out to be about 170% short. Which I don't really, like I said, for the short interest, the trade flow just has to work. Like I said, I just don't know what the margin requirements are, or like, again, if Joe shorts a position and it starts going so far into the negative direction, how do you calibrate what's the margin requirement versus how much the position's leveraged, stuff like that. So what I'm just saying is any short interest, like where you can't execute a trade, that's terrible. Like, at what percentage does that happen? I mean, is it at 110%, 120%? I don't know. Only for the trading environment do I care, not like some moral or philosophical point to not short more than the 170%. But in the hearing, the four players were, you had Keith Gill, which is just your retail trader, the Roaring Kitty, deep fucking value on Reddit. You had your Robinhood CEO, and that's your brokerage. You had the Reddit CEO for questioning about coordinated manipulation from the retail side. And then you had the market maker, the Citadel CEO. Citadel is just a market maker, and there's several of those. I don't know how many. And so what happens is Keith Gill puts in his order through Robinhood, the brokerage. The brokerage sends the order or tries to fill the order, depending on the brokerage, through many different market makers. So they talked a lot about that in the hearings. And then once the brokerages matches the trade through a market maker, the trade executes. So like I said, right off the beginning, there seemed to be no manipulation from anybody. Oh, and there was also Melvin Capital, a hedge fund. And so I just wanted to go over my takeaways. I watched the first hour of it diligently, and then I couldn't take it anymore because it was just the same nothingness. But the first thing I want to talk about was the hearing motivation. A stock appreciates. Actually, the first thing I wanted to say was bubble versus squeeze versus appreciation. I do think this was a short squeeze. Again, just the short interest being real high, and people start buying, and then people short can't cover or are trying to cover, and it causes the appreciation. Or price increase, but without the short squeeze, forgetting GameStop for a second, without a short squeeze, sometimes you'll just see a stock come up with no news, but it'll still appreciate 500%, and then it'll come back down. Without short interest, that is what I would call a bubble. With short interest, that is what I would call a squeeze. And then even like for like Bitcoin right now, appreciation, like the blow off tops, I don't consider those bubbles or squeezes. It's just the price action, hype, retrace, building the fundamentals, blah, blah, blah. Market mechanics, like we talked a lot, like I'm not gonna talk about, like we've already talked about long, short options and option spreads. Well, we haven't talked about option spreads in this, but we'll get there. I just don't execute many option spreads. But there's no moral, I feel stupid even having to address this, but there's no moral or philosophical right or wrong for long, short options, option legs. I mean, it's playing the volatility of the market. So the hearing motivation was really something like, there's a bunch of these retail traders sticking it to the hedge funds, and then Robinhood maybe pulled the plug right at the end for the retail investors so they couldn't continue the trade. And I just disagree with everything on the sentiment there. Right, Melvin Capital, if I forget, I think they had $8 billion under management. That's not a lot of fucking money for a hedge fund. Reddit users lost $27 billion. I don't give a fuck if Joe Blow loses his $300 he needs to pay his house. He should make better decisions. I don't give a fuck if a hedge fund manager makes or loses their entire fund and can't pay $8 billion. Doesn't matter at all. Actions have consequences. People need to take responsibility for their own choices. And so, right, it's a very sentimental thing like, yeah, I'm the U.S. Senator or House of Representatives. I'm going to question and grill these people and figure out what went wrong, or stand up for the American people, to stand up for the American Constitution, American rights, and obviously everyone in this country has American rights. But what really happens is you have a toxic people and one sentiment, right? I think I saw there was I don't know if people mistyped and said Keith Gill was getting subpoenaed or being sued. I read that he was being sued by, again, anyone who lost money on the appreciation, completely independent, their decisions, their responsibilities, blah, blah, blah. But anyone suing Keith Gill, just go fuck yourself. But now with that being said, like in the actual Senate hearing, he said today he thinks GameStop's a good fundamental company. I haven't reviewed the company, but good bet on that, or good luck with that. But my point is, it's like you have very clear defined narratives. You have the retail investor. I mean, this lecture series is for small retail investors to make a lot of money. But you have small retail investors, sticking it to the big guy. You have the big guy taking it away from the little guy. And neither of those things are fucking true because of market mechanics, because of how big the market is, because of how many players, because of how much money. And so you really see jumping to conclusions with this hearing, right? They always come in and they say, Keith Gill said, yeah, I bought the stock, I like video games. The short interest was low, but I think that he genuinely thinks that the company can come back. And now, is there some moral differentiation between making a long investment for you think the company's going to come back versus just throwing money at it because it's appreciating really fast? Or is it really morally bad to short a stock? Fuck no. I mean, super fuck no. And so any sort of emotion or morality into this talk past the actual legality, right? If Robinhood would have actually stopped trading for pressure from a hedge fund as opposed to just the margin capital clearing requirements, totally different story, but it wasn't. I mean, this is just shit happening. And the market maker, for the market mechanics, I would like to see if it's possible retail traders with a farther tick disclosure or bid and ask. That would be very cool. Let me check my camera. So I was saying, I totally agree if we could somehow have the retail investor have a farther tick designation for their bid and their ask. That would be certainly beneficial. Even for moderately small orders, it still matters. What else would I wanted to cover? Bubble, squeeze, emotional, race to the bottom, hearing motivation. Oh, the House representatives showed their illiteracy very well. Representative Maxine Waters, again, you really set the tone for we're gonna find the facts, but probably somebody did something wrong. Again, when you're profoundly illiterate, you can't ask good questions. So that was very well demonstrated today. I have margin up here. Again, I just don't know market maker to brokerage, managing, what's the rules for cleared funds, invested funds, margin, stuff like that. I just had to see it, not a complicated conversation. I wanted to say something else. Oh, the Reddit CEO is just fucking hilarious. Seeing the Reddit CEO, they go on there and talk about, they say they use derogatory terms. Those derogatory terms are typically, hey, you fucking retard, nice job. Or, wow, look at this autistic person go. And the scientific thing that I wanted to point out is that is the general societal awareness. Even people that trade for 5 seconds versus 50 years of the efficient market hypothesis being wrong, of asset correlation being extremely distributed. Because people calling each other retards and autists is really like an awareness of like, yeah dude, you didn't really do anything that amazing, but the price went in your favor, congratulations. And it's true, right? It's mathematically, scientifically, physically, economically, biologically, sociologically proven. And so to that point, now when you go over to Melvin Capital, right, it's always, like I said, the little guy versus the big guy with a lot of resources. We live in a global economy that produces $50 trillion, $60 trillion a year. You know, a global equity market, or U.S. equity market, not exactly sure, 500 billion, I'm guessing, 500 billion to a trillion, you know, 4x of 7 trillion a day. So none of these players are big guys in the context of a market. And so forget capital allocation, just for financially modeling, there's assuredly these people have no good models, and arguably more convoluted, more complicated models that make shit worse. For fundamental reasons, not, like I said, if you have a I see nothing wrong with high frequency trading at any point to any level. I mean, I high frequency trade, like, when I have real cash flow. I mean, I'll execute, I don't want to say hundreds, but like lots of orders a week, as a small retail guy. But there's no market mechanic where a fund at $7 billion or 7 trillion or 700 quadrillion dollars can build a better financial model. So, like I said, I agree with the short interest should be posted. I see it as rather neutral. Again, the short interest can and does change all of the time, so I don't see it as a great technical indicator. As long as the people have the same access to the same information. That's about all I wanted to say. Like I said, overall, I didn't expect there to be real manipulation. I mean, I watched it as it developed, just as an observer on Reddit. But you see a lot of illiteracy just in stock and investing to begin with, strictly because of market mechanics. Nobody stole, the $74 billion lost from the retail side, or however many dollars from the hedge fund side, doesn't fucking matter. And again, it's like, for the emotional race to the bottom and the sentiment, it's illiteracy and it's incapacity to develop your own skills. Okay, if you're an individual investor and you lost $500,000, should that be like devastating? Like, let's say that's all of your money. No. If you have any skill sets, like I said, sing, dance, music, programming, engineering, consulting, you can make that money back. I don't say quickly. I mean, as quickly as you lost it, you can make it back. And it's personal choice, personal literacy, personal development, and it leaks over into everything. This is the sentiment of, I lost out, I got hurt, now somebody has to pay for it, right? The people suing Keith Gill, if they're actually suing him, they're just looking to someone to sacrifice. And at the society level, forget trading for a second, that is the root problem of goddamn fucking everything. And it needs to stop, it needed to stop. I say it in every other lecture, sticking to economics here. But those are my thoughts on Ye GameStop. Hear ye, gather round. What happened? People traded pretty quickly for a little bit, and then we had a hearing about it. Thanks for watching part 14.